One of the best performing semiconductor companies, AMD, is up about 34% just over the last few months, which now puts them at a market cap of 121 billion and a PE of 45. And now it's time to determine whether or not we should be jumping on the AMD bandwagon to capture some of those portfolio gains on that stock appreciation now that their Q4 earnings have released. So make sure to stick around to the end of the video as we'll answer all your questions and more. How's it going? Welcome to Everything Investing. I hope you're having a great day. As always, we will talk about the fundamentals of this business. We'll talk about the trajectory of the business, and we'll use all of that, taking it all into account to produce an evaluation for this company. And at the end of the video, we'll conclude off by talking about our investment rating. Now, if you enjoy content like this, make sure to like the video, subscribe. It really helps out the channel, and always comment your thoughts on the comment section below so that we can have a conversation with your fellow investing peers. Now, with all that out of the way, let's jump into the video. All right, so AMD's Q4, year ending 2022 results. What do we know coming into this reporting period? Well, they actually came out with earnings per share at 69 cents per share on $5.6 billion worth of revenue. That's a 16% increase year over year. And so that's why you saw those shares have increased slightly after hours here. We did also see some weakness in their client and gaming segments. We will talk about that in just a minute. Gross margins actually are down 7% for the year now, but they said this is all a result of not only a weak demand environment, but also they had amortization of certain Zilix assets that were impacting the quarterly results there. Of course, they did just acquire this company. But with all that being said, analysts did expect them to come in at about 67 cents. So they just did beat them out with about 2 extra cents to spare. And same thing with an extra $100 million or so in revenue. Now, in terms of their outlook, though, again, due to that weakness in the PC and gaming segments, which are expected to continue here, they're expecting a revenue decline of about 10% on a year-over-year basis for next quarter. But before we go in depth on the trajectory of this business, let's talk a little bit about our revenues by segment by looking at this chart here from Main Street Financial Data, the first link in the description. And what we can see here is that during that period of healthy growth across all their segments, revenues definitely were on the incline. But now that we've shifted over to like a negative growth environment here, we're seeing that taper off a little bit here, especially on that growth. And you're seeing that especially in their client and gaming segments, which you can clearly see from this visual representation here and looking at this from a quarterly perspective. So that leaves us with our quarterly results here. Revenues of 5.6 billion, like we mentioned, gross profit at $2.4 billion. Okay, 43% gross margins. Operating expenses came in at about $2.5 billion. And of course, when we have operating expenses of $2.5 billion, gross profit of $2.4 billion, that's going to leave us with an operating loss here of 150 million, negative 3% operating margins for this quarter. Not a strong quarter at all. And I mean, when we compare this to last year's results as well, at this time last year, they had $1.2 billion worth of operating income and 25% margins, a huge hit to their operating income, down 112%. And as they alluded to earlier with the weakness in demand, this is kind of what you could expect here, especially since this business is a part of that semiconductor industry. The semiconductor industry as a whole is definitely a cyclical industry where it's heavily dependent on the demand for its products. And as I always say on this channel, the best time to purchase cyclical businesses is when they're in that downturn in the business cycle. But if we look at this from a year-over-year perspective, they still did come out with $23.5 billion worth of revenues. That translated to $10 billion and a half of gross profits. Margins still were in that mid-40s range. And so once we deduct for our operating expenses, those are up again 120% year over year. Not great, but still left them with about $1.2 billion worth of operating income, at least for that year. Now, margins have been massively hit, down 17 percentage points. Same thing with their operating income. So they're really going to have to clean up those expenses. And if we look at this Main Street chart, you can see how their expenses have really taken off, since that first quarter of 2022, where they've almost doubled from about $1.5 billion worth almost up to $3 billion worth of operating expenses. And that's really going to eat up those gross profits. And ultimately, you can see the impacts it's had on those margins over the last few quarters. So they're going to want to really clean that up on the margin side in order to improve those fundamentals for this business, because that is really what's going to attract investors. And so once we get down here to our balance sheet, we can at least look at this from a liquidity perspective here and see that they have about $6 billion worth of cash sitting there on that balance sheet. And you compare that to their debt. They didn't have any last year. They brought on about $2.5 billion worth. So nothing to ward off investors on this side. Very healthy balance sheet, at least. And so that's something that investors can be happy about. Now, if we look at this from a free cash flow perspective, didn't really tell us what they were doing with it, but they did produce $450 million worth of free cash flows for this quarter. Now, if we look at this from a year-over-year perspective, about $3 billion worth, pretty much in line with what they had last year, albeit with that hit to their free cash flow margins. But after a little bit of investigation here, I can see that, what they've really done with their free cash flows as well. They've taken on a bit of debt here, and they've also started buying back a little bit of their shares. So nothing I'm too upset about right now. They have a healthy liquidity position at this current point in time. But the main thing that you're going to want to be interested in here, at least from an investing point of view, is this current outlook for this business. Now, they're saying for the first quarter of 2023, they're expecting about $5.3 billion worth of revenues or so. Again, that 10% decrease that we talked about at the top of the video there on a year-over-year basis, with further declines to their client and gaming segments that are expected to come in the future, but their embedded and data center segments should actually grow. So hopefully those segments grow enough to offset the client and gaming impacts, but we're at an interesting turning point right now in the cycle where fundamentals have been hit, of course, industry-wide. And of course, if we zoom out here and look at this from a macro point of view, the stock is down about 50% from those highs in 2021. So like we mentioned, being a cyclical and everything, this may actually be a great and very important buying point here on that assumption that we will return to value up in that 150 price range. Now, before we talk any further about our evaluation here, you can see once again the cyclicality behind this business. There's bad times and then there's good times. And now we're back down to about $1.3 billion worth of operating income for this business off of last year's $3.6 billion worth of operating income. So if we expect that on the backs of an economic recovery here to a degree, higher demand for their segments, AMD can produce, just basically 2/3 of what they could last year, and they come in with about $2 billion worth of operating income. If we require a 10% return, they do not currently pay a dividend, and if they can grow at about 20% for the next 5 years, which isn't even near what they were growing at previously, and then for the 5 to 10 years after that, they can grow at about 15% on a 44 PE like they're currently trading at, the stock should actually be fairly valued at about $100 per share. So that's about a $25 increase from where we are right now in terms of stock appreciation. We've already seen that 30% increase so far over the last 6 months. So if you expect that they can achieve these growth metrics over the next decade or so, this may be a very interesting buying point for yourself. Now, if we look at this from the most optimistic point of view, where they can grow at about 25% for the next 5 years, that drops down to 20% on a 50 PE. Yeah, the stock should be up probably about $90 to $100 from where they are currently. And that would bring about a lot more investors. Now, of course, it's going to be a little bit of a challenge for them to be able to grow at these levels, especially given the current economic situation. So that's why I'm going to give you the worst case scenario here. Let's say they can only grow at, negative 1% for the next 5 years off the backs of this poor economy, if even from a global point of view here, which of course, seeing as AMD is a cyclical business, it's going to be really heavily dependent on that economy. So let's assume that after about 5 years or so, the economy finally shifts and the cycle reverts. They can grow at about 10% on a per year basis on a 38 PE. Let's assume that the PE does drop a little bit. The stock would actually only be worth about just less than $30 per share or so. And that would be the major hit there. And that's mainly because this is a growth stock, right? When investors are expecting growth of, 30 to 40% on a year over year basis, and then, they're met with revenue declines, earnings per share declines, and that margins even revert to negative numbers, the stock is absolutely hit hard because the business is no longer achieving those growth rates that was previously attracting all the attention investing. And that's always what happens. And that's the cardinal sin of all growth stocks, which we mention on this channel frequently. So in the worst case scenario, $30 per share, but they do have a strong cash position. I can't really see this business getting back below, about $50 per share. And that's kind of where they're bouncing off right now, right? So the last time they were there was back in 2020, bounced up all the way up over $100 per share. Now they're back down to that level and bounced up another 30% from those lows. So it seems like they're bottoming in and around that $50 per share level. I don't really see it getting below there. And at $75 per share, I'll give this an investment rating of a 6.5 at these levels. I would give it a 7. It's just not there yet. It was definitely a 7 or higher at $50 per share. But of course, now that we're up 30% from those levels, we've added in a bit of risk now. And like we mentioned, our margin of safety level is down and around that $30 per share level. So yeah, up at $75, not as attractive as an investment. They don't pay a dividend either. So they're really relying on that growth. And we're going to have to see over the next few quarters how this business transforms. So that's the analysis for today's video. If you've enjoyed it to this point, make sure to like the video, subscribe. Also make sure to comment your thoughts in the comment section below. And with all that, I'll catch you on the next one.